Daily market update, Saturday, 6th of June. Very interesting day yesterday. Markets were down quite heavily, particularly in the US. Nasdaq was down over 4%, S&P 500 over 2%, Dow Jones 1.34%. What went wrong? Everybody seems to be struggling to understand. We had a very strong employment report from the US, which sort of spooked the markets because when the economy is perceived to be strong, which means strong US job report, that means the US central bank is less likely to cut rates. And now there is a probability of rates going up. There's a very strong probability of rate hikes in the US now, off the back of this very strong US job report. So why tech stocks struggled in the backdrop of an expectation for rates going up? Why don't they like it? When rates are expected to go up, the bond yields go up. When bond yields go up, bond prices fall because they move in opposite direction. When bond prices fall, government bonds become more attractive, very, very attractive for investors. So they don't have to take too much risk investing into tech stocks when they can get a decent amount of yield from government bonds, a decent amount of return from government bonds. Why the returns become attractive? Because when bond prices fall, so you get a return, you get a guaranteed sort of returns from the US government because it's one of the safest governments in the world. So you get the guaranteed income from the US. On top of that, you get this extra return because you are buying those bonds at lower prices than usual. So your return improves, if that makes sense. So when that happens, markets, the tech stocks in particular, because they are growth stocks, their cash flows are far out into the future. So they come under pressure. The second reason, when we are using discounted cash flow calculation, so we use a company's cash flow as a numerator and we use the yield on US treasuries as a denominator. So when yields go up, due to the denominator effect, we discount those cash flows back to present using a higher rate. That means the natural outcome, the end result, is a lower stock price. So that is the second reason. The third reason is Broadcom. Broadcom delivers some decent, results on Wednesday, but markets is still not happy. Even the good news is not good news. So stock declined 13% on Thursday and another 6-7% Friday, despite having delivered decent results. So that is the market backdrop we are talking about. Am I personally surprised by what happened? Not really. Why? S&P 500 was up 9 weeks straight, consecutively. So 9 weekly gain, 9th consecutive weekly gain. So all markets needed was a bit of a catalyst for a pullback. Is this a pullback or a correction? It's not a correction. Correction in technical terms means a decline of more than 10%. Markets fell by less than that. So why is everybody panicking? I don't understand. Is there a reason to panic? Probably not. Because when you look at the economic fundamentals of the US stock market, their economy remains incredibly strong. The earnings are decent. If you look at the S&P 500, in terms of Q1 earnings, the earnings improved by 28%, which is excellent. So why everybody is panicking? I think because market had done so well, people are starting to get used to only strong positive returns, and they got absolutely spooked when they saw Broadcom, declining by, double digits, etc. So that's why I always say, make sure you are not overexposed to a certain theme, to a certain sector. Make sure you are diversified by style, by geography, by sector, and by asset class. If everything in your portfolio went down yesterday at the same time, that is a strong indication that your portfolio is not truly diversified. You don't want everything going up at the same time or going down at the same time, because if they go up at the same time, every single thing in your portfolio, that means they can come down at the same time. So this is not how diversification works. This is not how institutional professional investors build their portfolio. So that's why I'm all about long-term, time in the market rather than timing the market. If that's what you're after, hopefully you will find some value on this channel. And you are very welcome to like and follow along. And if you've got any questions, particularly about yesterday, what happened, what went wrong yesterday, you're very welcome to drop it in the comments and I'll come back to you. All the best. Cheers.